Well, good morning. I'm Jagender Rana. Topic of the day is widespread mis-selling of insurance in India. Widespread mis-selling of insurance in India. Insurance-related mis-selling is rampant in India. And we suspect in many other countries as well. As per the Council for Insurance Ombudsman's Annual Report 2020-23, mis-selling related grievances for life insurance accounted for 58% of the total entertainable complaints of the year. Further, in 22-23, the RDI received around 1,24,000 complaints against life insurance providers, with 20% related to unfair business practices. Sales agents often employ pressure tactics and push life insurance plans that offer poor returns and inadequate insurance coverage despite high premiums. They tend to make this push without a thorough understanding of the customer's needs. To make matters worse, opaque policy terms and complex fine print from insurers, along with misrepresentation or omission of critical information by insurance agents, create confusion and potential pitfalls for customers. Say, for example, Kishan, a farmer from northern India, met with an insurance agent and purchased an endowment plan, a type of life insurance policy that pays the full sum assured to beneficiary if the insured dies during the policy term, or provides the sum assured upon maturity if the policyholder survives the term. The insurance agent talked up the potential returns and assured Kishan that the premium payments would be manageable within his budget. Kishan trusted the agent and signed the insurance form without fully understanding the implications of the premium payments. Over time, he struggled to meet the premiums. After 3 years, he finally surrendered the policy, hoping to salvage some value. To his dismay, he discovered that he could not recover even half of what he had paid in premium. So Kishan's case highlights systematic issues of information asymmetry and mis-selling in insurance, where sellers misrepresent crucial details, leaving vulnerable individuals financially exploited. Agent incentives don't match customers' needs. Higher commissions lure some agents into such tactics. So commission levels are set by insurance companies within the IRDAI regulatory framework as a percentage of the premium paid by policyholders. Therefore, agents often try to sell endowment policies with higher premium rates in order to get the higher commissions. Additionally, agents receive significantly higher commissions from the first year premium compared to subsequent years. So to maximize their earnings, some agents encourage policyholders to prematurely surrender existing policies and sign up for new ones, thus earning another first-year commissions. This practice, known as churning, burdens customers with surrender costs they are often unaware of. Under current IRDAI regulations, a policyholder who surrenders a policy early receives a surrender value much lower than the total premiums paid. For example, if a policyholder surrenders in the second year, she receives only 30% of the premium paid up to the year, bearing a surrender cost of 70%. Unethical practices like churning, concealing surrender cost, and pushing high premiums, low return plans stem from agents' incentives tied to high first year commissions. So the gain for the agent contrast with the loss to the policyholders who are at a disadvantage due to lack of transparency around surrender value and costs. Then demonizing consumer trust in insurance agents. Individuals like Kishan buy insurance expecting financial protection. Rural customers tend to trust sales agents and rely on them as the primary channel for the purchasing insurance. However, the reliance can be concerning when combined with a low level of awareness of consumers' risk in insurance. Most low-income customers are unable to discern unfair sales and marketing tactics used by agents. So, accelerating their vulnerability without clear information about costs, premiums, and surrender policies, these clients face increased financial risk, demonizing their trust in insurance and driving negative word of mouth publicity for the entire insurance industry. So regulators and providers must enhance customer protection in insurance industry. Transparent practices, ethical sales tactics, and responsive customer support are essential to build trust, protect customers, and sustain the insurance industry's growth. Here are some strategies that can be implemented. Before that, let's see, insurance is a critical tool and act as a shield during the uncertain times. Insurance offers plenty of benefits and helps recover from accidents, illnesses, and natural disasters. However, the insurance sector is not immune to malpractices that some insurance agents engage in for minor incentives. Mis-selling insurance is one such scam that aims to deceive customers into purchasing insurance policies unsuitable for their needs, further leading to financial loss for the policyholders. Mis-selling an insurance occurs when a policy is sold using misleading information or by omitting crucial details about the product. So, in this comprehensive guide, let us see. Insurance mis-selling is hard to spot as it takes various forms, from overstating a policy's benefits to concealing major facts and costs. Fraud insurance agents might mislead customers about the terms and conditions. Understanding these tactics is the first step towards safeguarding yourself against such scams. See, the government has sought suggestions from leaders on steps to curb mis-selling through banking channels as part of efforts to strengthen regulatory oversight of the bancassurance model. Bancassurance is a partnership between banks and insurance companies to sell insurance products through bank branches. Some of the measures being considered may include a cap on commission charges paid to the banks for selling insurance products, stricter disclosures of commissions while selling policies, and delinking bank employees' performance appraisals from insurance sales target. The last month, Financial Services Secretary held a meeting with chiefs of the state-run banks over issues related to bancassurance, including its effectiveness in increasing insurance penetration and challenges in the form of mis-selling. So in 22-23, the contribution of banks as corporate agent was 5.93% in the non-life premiums and 17.44% in new business premiums for life insurance. Both life and general insurance councils are working on it. In October 2023, the RDI has set up a task force to review the existing banking intermediation model and carry out modifications in the regulatory framework. One suggestion is that there should be a cap of around 15% of the total premium on commissions and other charges paid to banks for selling insurance products. So, in order to enable and provide flexibility to insurers to manage their expenses within the overall limits based on their gross written premium, Replace the cap on commission payments with the overall cap on expenses of management of insurers. The maximum amount that can be incurred toward EOM, that is expenses of management, is 30% of the gross written premium for that financial year. In the case of a standalone health insurance companies, the limit is 35% of the gross written premium. Now, soon insurance agents may be required to maintain audio-visual records of their sales pitch, where they must read out a summary of the policy features to prospective buyers. With multiple cases in consumer forums and thousands of complaints of mis-selling, the Consumer Affairs Department has written to the Finance Ministry seeking a change in rules that the terms and conditions, or at least the summary, should be clearly explained, as it is not properly communicated, resulting in disputes. In a letter to Financial Services Secretary, the genesis of the dispute often lies, it is mentioned, the genesis of the dispute often lies in lack of proper communication, as the consumers often complain that only positive aspects of the policy are told to them when insurance is sold. So a final decision on the issue will, however, have to be taken by the IRDAI, which sets the rule. Also flagging that terms and conditions in insurance policies are often in ambiguous languages, which are not understood by consumers. This is not even in the regional languages concerning the rural population of the particular area. The Consumer Affairs Department has also suggested that the policies must make the inclusions and exclusions extremely clear in the terms and conditions. In several cases, when policyholders apply for the claims, the insurance company representatives inform them about the exclusions then. Such clarity in policy documents will also bring down the litigation in the sector. Another suggestion by the National Consumer Dispute Redressal Commission is regarding the rejection of medical claims by hospitals if a policy holder is not hospitalized for at least 24 hours for surgery or treatment. As advancements allow for treatment and surgeries to be completed within a few hours, it is imperative that such a clause be re-examined and suitably amended. There are some strategies that can be implemented to control or to curb mis-selling. First, to enhance monitoring and auditing. Customers are over-reliant on agents when they purchase insurance. So regulators and providers should ensure regular audits and compliance checks to ensure adherence to regulatory standards. Although the IRDAI has established a code of conduct for insurance agents and intermediaries, its compliance should be monitored. Insurers should be mandated to monitor the sales pattern, analyze complaints, and detect mis-selling. The regulator will need to take corrective action against insurers found violating norms. Then standardized policy information. Policy documents are complex, lengthy, and filled with jargon, making them difficult for people to understand. This leads to widespread information asymmetry. Insurance companies should share key information on premiums, surrender values, exclusions, claim rates, customer support, and more on standardized user-friendly templates. These should accommodate language preferences, communication modes, and intuitive design for clarity and accessibility. Then balance customer interest. Most Indian life insurance companies opposed a 2023 draft proposal which would have set a limit on policy surrender charges. The RDI's recent decision to scrap this proposal benefits the insurance companies but not the customers. High surrender charges can be perceived as a tactic to lock in policyholders, eroding public trust in the insurance industry. Therefore, the regulator must allow some flexibility to balance the interest of both insurers and policyholders. Then promote customer support and grievance resolution channels. Although the IRDAI has developed an integrated grievance management system that is called IGMS to handle and resolve complaints efficiently, the customer awareness of the system remains limited. Customers rely on their agents to register grievances, thus depending on the very people who may have missold policies in the first place. This process delays resolution. Therefore, the IRDAI should widely promote IGMS and push insurers to speed up claim resolution and response times, and enhance customer understanding of insurance through gamification can simplify complex subjects and makes learning about insurance policies, policy types, benefits, and conditions engaging by integrating quizzes, story-based adventures, role-playing, and virtual simulations. So this approach helps customers retain information better, ultimately empowering them to make informed decisions while enjoying the process. Insurance providers can incorporate gamification into their mobile apps, enabling customers with smartphones to learn independently. For low-income customers without smartphones, internet access, or technical proficiency, insurance agents can guide them through gamified modules and offline resources during in-person consultation. Additionally, SMS can be used to deliver quizzes, tips, and educational contents. So protecting insurance customer is increasingly important as risk and complaints are rising. These steps will lead to better financial outcomes, reduced distress, and more responsive competitive insurance industry. Now let us look at what form these scams can take. First, exaggerated benefits. It has been seen that fraud agents overstate the benefits of a policy, making it more appealing and a one in a million deal. This includes false promises or guaranteed returns on investment-linked policies or extensive coverage amounts, then hidden costs and charges. Another common tactic is not disclosing all the costs associated with the policy. This includes hidden charges, fees, and penalties for withdrawal or cancellation, and misleading information about coverage. Agents may provide false information about the policy's coverage, which can lead to a false sense of security about the protection you are purchasing. Unnecessary policies. In most cases, older people are sold policies they do not need, such as an expensive life insurance policy to someone with no dependents or a high level of existing coverage. Now the question is how to spot insurance mis-selling. Because spotting mis-selling involves a good understanding of insurance products. Here are some tips to help you identify potential mis-selling. Say, do your homework before meeting with an agent. Research the insurance policy that best suits your needs. Look for the policy that caters to your needs, but also compare policies from different insurance companies. This knowledge will help you identify with an agent is suggesting unnecessary coverage. Ask questions. Feel free to ask for clarification about the policy benefits, limitations, cost, and any other details. A legitimate agent can answer your questions clearly and provide an understandable answer. Always read the policy document thoroughly before signing. Also look for any difference between what the agent told you and what the document states. So if you need clarification on the policy being offered, seek advice from a financial advisor or another insurance professional like Insurance Samadhan or any other firm. So these parties consist of experts from the insurance companies who catch any discrepancies included in the policy. In most cases, agents will put unnecessary pressure on you to make an immediate decision by giving false deadlines or reasons. They will pressure you to sign up for a long-term commitment without providing a thorough explanation. Don't just be a victim of insurance mis-selling. Make a contribution to stopping such nasty scams. Stopping mis-selling requires thorough research and knowledge-based policies. But if you find yourself in a state of scam, you can do certain things like report suspected mis-selling, educate yourself and others, support regulatory actions. The insurance scams are constant, but you can protect yourself from the above-mentioned methods by understanding the tactics used in mis-selling and how to spot them. Thank you. Thank you very much.